Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show. As always, just a gracious host, the Prince of Investing, coming all the way live from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So if you are catching this episode live, feel free to comment and tell me where you're checking in from. But today, ladies and gentlemen, tomorrow, Coinbase is going public. Coinbase is doing its IPO, and we want to know, will it be worthwhile? Everybody knows that Coinbase is taking over, has about 11% of all the cryptocurrencies that are being traded. One of the largest cryptocurrencies is Change, and it's the first one of my knowledge of exchange currencies that are going public in the market. So here on the Investor Show, of course, always, we're going to look and see if that's a great opportunity for investors. But without further ado, I know you guys and girls, while you're tuned in here, you're tuned in to see my guest today. My guest today has a long list here. This is Dr. Robert Smith. He's a mathematician. He studied market cycles. He's from Cycle TV, and he's the CEO of, make sure I got this right, the Foundation of Market Cycles. Hopefully I didn't screw that up. Cycles of Foundation, but he's going to come on and get me right. But, he spent a long time, mathematician, breaking down the math, and he wants to give us an inside look of how the big investors, the techniques that they use that can be applied to the small investor. So he has a book coming out, all of the great stuff. But without further ado, ladies and gentlemen, give a nice round of applause to my guest, Dr. Robert Smith. How you doing, Doc?
I'm doing good, Tim. Great to be here. How are you?
I'm doing good. I'm glad to have. I didn't even get where you at right now.
I am in Virginia.
Okay, you're in Virginia. Okay,
yep.
I kind of butchered your introduction there a little bit.
Right.
I know that you're a mathematician.
We're just getting to know each other.
We're just getting to know each other before the show, and I want to. So when people tune into this, people that are catching this live right now across the globe, and the people that are catching the playback, tell us a little bit about yourself, Dr. Smith.
So I did my PhD in decision making under uncertainty, and finished up in 2000, right about the time that I was also getting interested in the stock market. Had run my account up about 300% in 18 months, and I was really patting myself on the back. What a smart guy I was. That PhD is really paying off. And then March 2000 hit, and my 18 months of gains evaporated in about 18 days. And so that was really kind of an eye-opener, and let's call it love at first bite, if you will. So I got really smitten with investing. And then I started a company, a financial technology company in 2005. Was one of the first websites to offer trailing stop losses alerts to investors back in 2005. Grew that to about 30,000 customers and developed it into really a pretty unique portfolio and risk management platform that most retail investors hadn't really had access to before and hadn't seen before. So my passion is all about bringing sophisticated professional tools down to the people so that the people can be involved in the markets in an effective way, and I've always been concerned about kind of the way that retail investors interact with the markets and the way market professionals interact with retail investors. I don't think it's really square. But, in the end, we only have ourselves to blame, and we got to wise up. Thankfully, guys like you are out there talking to the public and helping educate the public, because there's a right way to invest and there's, a million wrong ways to invest. So,
okay.
So that's what I'm working on. And I've been at it for 25 years now.
25 years. That's a long time. But one of the things I want you to hit on that I really like about your story is something I always learn when I talk to people. I learn a lot from people's success, but I also learn even more from people's shortcomings of failure. Now, you spoke about this earlier. You said in 1998, you ran your portfolio up 300%. And you said, I'm the smart guy. I have figured it out. I'm a genius. My PhD is passed. It is paying off. And you said you lost everything. And this was the dot-com bomb of 2000, correct?
That's right. Yeah.
Now, this dot-com bomb of 2000, what can you explain to people? How did it happen? Because history always repeats itself. Like, we're going to speak about market cycles. So how did it happen? How did you lose 300% in a matter of 18 months, you said?
No, I made 300% in 18 months, and then I lost it. 18 days is a bit of an exaggeration, but it wasn't. It was a lot quicker. Markets go down a lot quicker than they go up, right? And so that is what happened. And most people have no plan about when to sell. And then things start going down, and you start lying to yourself, right? So I remember, I started with $10,000. Okay. I was up over $40,000 at the peak of my account in early 2000, right? And then the market started correcting March of 2000. Amazon eventually went down 95% over the next couple of years. Amazon, right? And now Amazon's, one of the most valuable companies in the world. So sometimes this happens in markets. And when most people are flat-footed, when markets kind of do their thing, and make everybody feel some pain, whether it's short-term or long-term, hard to tell. But in this case, I didn't have a plan. I didn't have a plan of when to sell. And it started going down from $40,000 to $30,000. And then I said, I don't want to get greedy. I'll get out when it gets back to $35,000. Then it got back to $35,000. And I thought, it could go back up, could get above $40,000 again. Why couldn't it go to $50,000? And then blammo, pretty soon it was $25,000. And then $20,000 and then finally $10,000, which was my original capital. And I said, that's it. I'm out of here. Taking my money and going home and crying on my pillow for a couple of years till I figure this out.
Now, I'm going to answer this question. When some people saying, hey, when the market goes down, that's the time to buy. Just ride it out. Just put up your umbrella and just get through the bad times. Why didn't you do that, Dr. Smith? It was just the companies just wouldn't rebound, or they were bad companies. What happened,
Because I didn't know what the heck I was doing, Prince. We're all in the markets. Markets are tough, man. And, they're no different than flying an airplane, in my estimation. And people wouldn't just walk out to the runway, hop in the plane and say, I got this, step aside, clear the runway. I'm taking off. You're going to die. Right. And so, markets are sophisticated. There are a lot of sophisticated participants, a lot of sophisticated technology. And, it takes a while to learn what you're doing. But one of the biggest things that I learned early on, and this is the thing I share with everybody, 2 Nobel Prizes in economics now have been awarded for.
You hold on, wait. Yep. You got 2 Nobel Prizes?
No, not me. I said 2 Nobel Prizes in economics have been awarded for pointing out that we hate to lose. Okay. But there's a rub. The fact that we hate to lose leads to different behaviors when we're underwater on an investment versus when we're up on an investment. Okay. So I'm talking about Daniel Kahneman, if you've come across his work at all, and then Richard Thaler more recently. So when we are losing, right, when things are going down, we are risk seeking, because the fact that we hate to lose makes us not want to sell. Okay. So we take more risk, we hold on longer, we double down, we triple down, we turn a short-term trade into a long-term investment, et cetera. Right. And that's why I say we lie to ourselves, and you know what? The higher your IQ is, the better you are at lying to yourself.
We gotta put something in there for that one.
Yeah, because you're really good at making up narratives to explain any data that you want. So you start to convince yourself that, you can really spin up a story if you have a high IQ. So
that's a gem. That's a gem there. That's a gem, ladies and gentlemen. High IQ, the better you lie to yourself. High IQ. That's my little sound effects there that I, to say high IQ, the better you lie to yourself. Now, going back to this .com bomb.
Well, let me just tell you the punchline here with the when you're winning, when you're up, the fact that you hate to lose attaches itself to your profits, and you tighten up. You become risk averse with your winners. So you're risk seeking with your losers and you're risk averse with your winners.
Risk.
And the market works exactly the opposite. Markets have momentum, and people need to learn to be risk averse with their losers and risk seeking with their winners.
Okay, so we are risk adverse with the winners.
Yeah,
and
it's hard to hold on to a winner. It's hard to to have 1,000% gain in a stock.
So, okay, when you're looking at, so essentially what you're saying, you're telling everybody, hey, when we're up, hey, I don't want to lose. I don't want to lose when we're up.
I don't want to let those profits get away from me.
But when we're down, we're like, oh, well, I don't want to lose, so I want to put more in.
Yeah.
When we should be the other way around.
We double down on our losers when we should be doubling up on our winners.
Okay, let me ask this question then. Going back to .com bomb in 2000, what Dr. Smith would have done different?
Well, a few years after that experience, I learned about trailing stop losses. So a trailing stop loss is the simplest way to be risk averse with your losers and risk seeking with your winners. Okay. So what is a trailing stop? You buy a stock at $100 and you're using a 25% trailing stop loss. If that stock goes straight down from $100, never gets a penny higher, right? When it falls below $75 on a closing basis, you would sell that stock and say, I got stopped out. Okay. But if the stock goes up $100, it goes up to $150, $200, right? Now your 25% trailing stop is at $150 if your stock made it as high as $200. Okay. So what that does is it puts a floor under your losses, right? But it also takes the ceiling off your gains. So I always said people take irrational losses. I want people to learn how to take irrational profits. How do we let markets go nuts every once in a while, right? So how do we let market madness blow up our portfolio in a good way instead of blowing a hole in our portfolio in a bad way? So a simple trailing stop, even something like a 25% trailing stop for somebody who's holding stocks for a year or more on average, will do that for you. It'll put a floor, it'll make you risk averse with your losers, and it'll uncap your winners. Okay. So I learned about this from a friend of mine, Dr. Steve Sugarud, taught me about trailing stops. And I back tested his portfolio. Okay. Guy I learned about trailing stops from, he writes a newsletter. And when I just ran a mechanical trailing stop loss exit strategy, okay, don't sell unless your trailing stop is hit, period. It outperformed what he had done on his own. And I said, how could that be? Because he was already using trailing stops, I know, so it should be basically the same. But what happened was he was selling losers based on a trailing stop, but he was getting out of his winners early. And I found that to be true for myself, so now I do everything I can to put myself in a position for the market to just blow my mind in a positive way, right? So being invested in Bitcoin is one good example. I bought Bitcoin back at $3,000-$4,000 at the time. This was 2017, 18. It felt crazy buying it or $3,000 or $4,000. It was scary as hell,
Congratulations.
But I didn't buy too much that I couldn't just let it ride because this was an asymmetric bet, right? And so now it's at $50,000, $60,000, and it's been one of the best investments of my life. Wow. But I didn't put too much into it that I was gonna, not be able to ride that, carnival ride up and down, right? So
let me ask you this question. So someone says, you know what, Dr. Smith, that's a great idea with the trailing stop.
Yeah.
I own a share of Apple. Where should I put my trailing stop?
How long do you want to hold Apple for?
So they say, hey, I'm a long-term investor. I'm 5, 10, 15 years or whatever. Say, hey, I'm a long-term person. And should I even have a trailing stop, or should I just let it ride?
I think if you're holding for 5, 10, or 15 years in Apple, then you don't need a trailing stop.
Okay. Now,
And
who do you
Apple
recommend?
is but Apple is a blue chip company at this
Mhm.
point, right?
Yeah.
Um, they have a huge moat.
Oh, I like that
It
word.
doesn't
Oh,
look like they're going away anytime soon, right?
mhm.
This is a stock that, there's not a ton of uncertainty about this stock. But you think about other stocks that, people invest in, and penny stocks, et cetera,
Mhm.
you have no clue what's going on in these companies,
Well,
and then you get your ego caught up in the fact
mhm.
that you bought it, so it's got to be good. And if it doesn't turn out to be good, somehow there's something wrong with you,
Mm.
right? In those situations, you do have to have a way of making sure that you don't really hurt
Okay.
your portfolio. So,
All right. Well, Doc, let's get down to it. We're going to come back. I know what everybody's tuning in. We have a live audience here. Round of applause, everybody that's in the audience. We get some live comments in here. Somebody saying, good job. Someone says here, I love the Michael Davis. What's going on? He said, I love the trailing stop. If you don't stop out whatever your percentage of dollars amount, it has the percentage to go higher and will to go continue to go up. So
got
congratulations.
it, Michael.
Yep. Well, now it says good point. He's giving you the thumbs up. It looks like over there, and said wealthy evening from North Carolina. Okay, so yes, Prince, I'm excited about this live. Lucky's mom. So yeah, we got a nice little audience in here. So yes, so let's get down into why everybody is checking out today. Let's get to the question of Coinbase. Coinbase coming out tomorrow.
Yeah.
It is the IPO, that's it's scheduled to come out tomorrow, the Coinbase IPO.
Yeah.
Doc, what you got to say about Coinbase? How do you feel it's who is this going to be its competition? What's going on? Coinbase IPO. What do you think?
I'm excited about Coinbase. I don't usually buy IPOs, but I'm going to dip my toe in this one. I've
Mhm.
been a Coinbase user myself. I think Coinbase is the gold plated brand of cryptocurrency for the average person. They have 56 million users at this point. Do you know how hard it is, Prince, to get 56 million users, man?
Yeah.
That blows Robinhood out of the water, right?
Mhm.
So they have 56 million users. And you know what? Most of those users are pretty darn happy with Coinbase
Mhm.
because they've made money. And I like to say Coinbase was their first crypto kiss.
Mm. Okay.
And so they have incredible brand power, in my opinion. And I think that they are going to be one of the major brands in the crypto blockchain space. And I think that crypto and blockchain are going to play increasingly important roles in our economy and in our technology.
Okay. Now, not crypto, but Coinbase itself and crypto.
Yeah.
Who do you think is a competitor to Coinbase? Like we can look
Oh,
at the S1 filing that came out, I don't know, about a couple months ago on Coinbase, and I mean, they look great. I'm not going to lie to you. The finances look great. It's very rare that I even seen. I don't know about your experience, Doc, but I know you got way more experience than I do. But um, it seems that it's very rare you see IPOs that come out that are already profitable, already making money with a large user base.
yeah.
Like Airbnb came out. Airbnb has many, many users, right? But
Hmm.
it's not profitable. Uber
Yeah.
is not profitable, right?
Yeah.
So Coinbase is coming out saying, hey, we're already profitable. We have a large, we're kind of the golden child. My question is, who is the competition to Coinbase?
Well, a lot of their profits right now are coming from the fact that they can charge some pretty hefty transaction fees
Mm.
on buying and selling of cryptocurrencies. And I do think that their margins in that business are going to come under pressure. You can buy and sell cryptocurrencies at lower margins than you can on Coinbase in other places, right?
Mm.
So um, don't tell Coinbase, but when I wanted to take some profits in Bitcoin, I moved my Bitcoin over to TradeStation and
Mm.
I sold my Bitcoin on TradeStation for a lower transaction fee, right? So Coinbase is able to charge unusually high transaction fees right now because of their brand and because nobody else knows where to go. But that's going to change, so they're not going to be able to sustain the level of profitability just on their margin, on their transaction fees right now. You sell one Bitcoin at $60,000 and you pay 1.5% to Coinbase, you do the math, that's, what is it, $900 or something like that?
Yeah.
Right. So, that's a big chunk of change to, trade something that's supposed to basically be trading for free. Right? Like you and I are going to trade a Bitcoin. We can do that with our phones for just minor fees, right? So, so that's, I think that's going to be something that they have trouble sustaining. But I think that because they are such a trusted brand with such a huge user base, and because I think crypto and blockchain really are going to be at the center of our technology future, and not just as currencies, but as really as a new internet, in my opinion. I think Coinbase is going to be like the Apple or the Tesla of this crypto blockchain world, and I think their brand power is unmatched in the marketplace right now. So
I would agree.
I'm a buyer, even though I think that it's going to be volatile. There's going to be ups and downs. There's going to be scary times, but I think they are the Apple and Tesla of the crypto blockchain space, and I think that space is going to create companies, on the order of the biggest companies in the world today.
Okay. Now I have to ask you this question here. We got to get into this one now.
Okay.
Now we know Coinbase is opening up tomorrow. They evaluated it anywhere between 50 million to 150 million, if I think I read that correctly. Would it land in
64, 65?
64? Okay. So 64, 65, and we know what IPOs do. They shoot up the first day, and it's going to be a crazy rally, all those things like that. Doc, I got to ask you this question. Would you buy Coinbase when it IPOs, or would you wait until after the lockup period?
Here's the thing, Prince. You don't have to buy your whole position at once. To me, where most investors, non-professional investors, get themselves into trouble, okay, is when they put too much money into something that's more volatile than they were expecting. So if a darn mattress company hadn't coined this term, I'd have called it the sleep number. What's your sleep number? Right? How much money can you put in Coinbase today or tomorrow, where if Coinbase does rocket to the moon and never looks back, you're like, hey, I got a piece of that. I'm happy, right? But if you go thinking there's nowhere to go but up for Coinbase, and you put your whole enchilada into Coinbase, and then turns out there is somewhere to go but up for Coinbase, it goes down, right? Regulators come out, whatever, or their margins get squeezed on their transaction fees, and they have to go down to 0.5% instead of 1.5%. There's a million reasons why Coinbase could be worth less than $100 billion right now, right? So, you'll be feeling the pain. So in a situation like this, I like to take 25% of what I consider a full position and put it on right away, so that if Coinbase does rocket up and never looks back, then I can be happy that I had a part of that, right? And then maybe at the lockup period, I keep an eye on that, and maybe the insiders start selling, or maybe the media works up a storm around that, and the price comes back down, and I can take another 25% of my position, right? So I think that that's kind of the way you have to think about it. I think markets are frothy, and there's a tremendous amount of speculation and quantitative easing, et cetera, that have made markets at some pretty high levels. That's definitely feeding into the valuation that Coinbase is enjoying at this point in time. And so there is risk here. So don't put too much money into it that you can't sleep at night if Coinbase ends up falling 50, 60, 70%. Amazon fell 95% after the dot-com bust. Okay. And now they're one of the biggest companies in the world today. This happens with new technologies, and it could happen with Coinbase. It's not out of the question. Not going to be a straight ride to the moon. So that's how I do it. You know, I would be concerned about the lockup period. I'd want to keep an eye on that. I haven't done a lot of studying of lockup periods. Just intuitively, it makes sense when the insiders get to sell that there's going to be selling pressure, right?
Yeah.
But who knows, man? You know, it could double tomorrow and never look back. And I do think it's going to be one of the biggest IPOs of the year, because I think Coinbase is the brand that people associate with. I've heard about this crypto thing, this Bitcoin thing. I'm scared to death of it, but Coinbase seems like a safe way for me to get a little piece of that pie.
Okay. I got to ask you the next question, Doc. We got a question here from the audience. I think it's pretty cool. Deidre Gilchrist, he said, what kind of trailing stop would you put on Coinbase, or would you even do one at all?
For buying 25% of my position for a company that's going to be a long-term hold, I wouldn't put a trailing stop on that at all. Coinbase is an asymmetric bet. You know, to me, it's at least a 10-to-1 payoff if it fulfills its potential. And so that's a long-term hold for me, because I think it is going to be 5 or 10 years before the internet is rebuilt on blockchain. So, but again, if you have a 1-year time horizon and you are thinking of this more in terms of trading than investing, then on a stock like Coinbase, I like to use what I call volatility-based trailing stops. So basically, I think that you don't have historical data on Coinbase, so you have to kind of go by, what other IPOs have done. And, you're going to have to use something probably like a 50% trailing stop on a stock like that if you don't want to get stopped out just by the volatility. And then after it starts going up and you start wanting to lock in more of your profits, you can tighten that up.
Okay. Good question there. Now I have a question for you. We spoke about this earlier when we talked about the IPO getting ready to come out, and you said Coinbase is going to be around about 60, 65 million.
That's just what I read online.
They said so. Yeah, what I was kind of seeing, I was somewhere between 50 to 150, and their market cap may just shoot through the roof when they IPO. I think it probably will. I think it'd be pretty exciting. Now, the question I have to ask for you now: do you think this is being overvalued, or you think this is under or overvalued? Coinbase, this new company, like you said, they're already overcharging. They're getting away with it. We got to remember the Robinhood effect. What made Robinhood popular? Robinhood, the biggest thing that made them popular, because they came out and said, "Hey, no fees." Everybody's like, "What? I get to trade stocks with no fees?" When the rest of the industry, low end, was like $9, $10. $10 was a good fee to buy and sell stocks. Robinhood came out and said no fees. All of a sudden, Robinhood now is a household name. I mean, lately it's had its shakeups, but it became a household name by saying no fees. With Coinbase making so much money from fees, aren't they opening themselves up to a competition? So how do you feel right now at $65 million? You feel Coinbase is overvalued or undervalued?
I think in this market, 65 billion, excuse me.
I'm billion. I'm sorry. Was I saying million?
Is I can't remember, but I think I started to say million. I think it's fairly valued in this market. I am nervous about this market, Prince. I do think that we're we're on a high floor of this skyscraper, right? I did an interview recently with a man named Jay Capel from Sentiment Trader over on our Cycles TV channel for the
Mm-hmm.
Foundation for the Study of Cycles. And he was talking about the Shiller PE ratio, right?
Mm-hmm.
So it's, I think, 38 right now.
Mm-hmm.
So it's sort of like, you're on the 38th floor of this skyscraper, and that's a pretty high floor, right? So doesn't mean it can't go higher. They've gone higher before. I've heard some compelling arguments from Kathy Wood over at ARC
Mm-hmm.
that, back in the days of the telegraph and the automobile coming online, you saw PEs in the area of 100 to 200. So, you don't know a bubble until after it's over, but I think that there is more risk to the downside than people are expecting.
Okay. All
But
right.
that doesn't mean it's not, that doesn't mean it's overvalued, right? So this is why, for myself, I can't go take a full big position in Coinbase right now, but I do want to have um, at least a partial position because I think it could go a lot higher from here.
Now, what do you think? What would be the dream? What would for you to say, hey, you know what? I'm going all in. This thing is going to the moon. Buckle your seatbelts. Get your chin straps tight because this thing is going. What would have to happen? What would Coinbase have to do to make you take that philosophy?
Well, I would never take that philosophy because I wouldn't put all my eggs in one basket.
Mhm.
I don't know if diversification is quite the right word, but
Mhm.
I'm not like I'm mostly in equities and cryptocurrencies myself. I don't have bonds, um, but I do think that it's good to have about a dozen to 15 core investments in your portfolio, and that's what I strive for. I'm a little higher than that right now. I'm probably closer to 20. But all of your eggs in one basket, no. So what I would want to see for Coinbase to prove to me that they really are going to be the Apple or the Tesla of the crypto and blockchain space is that they start to really diversify their revenue streams and they start to show that, hey, trading Bitcoin and Ethereum was a great way to do customer acquisition.
Mhm.
They got 56 million customers and they're profitable. That's nuts. That
Yes.
was a smart play, right? But now that you got all those customers, you're not going to be able to maintain those transaction costs. You got to show me that you really understand that crypto and blockchain are the future and you have to diversify your revenue streams and you got to start innovating and really leading the pack, leading the world in terms of bringing this decentralization revolution into the public's consciousness because it's happening behind the scenes. DeFi, decentralized finance, smart contracts. It's not a done deal, but there's a tremendous amount of innovation going on behind the scenes. And I'd really like to see Coinbase get out in front of some of that and start to really bring the public's awareness to the real innovations that are going on in the space.
Okay. I definitely agree with you on that, saying that, hey, they already have 56 million users and they're profitable. That's a customer base that they can sell all type of products to or any type of subscription. So that's a very good
Yeah.
point. Now
Yeah.
you hit on this, you kind of been touching on it already with different type of things that Coinbase need to do, multiple revenue streams, having those high fees. They're making a lot of money from that, but they're not going to be able to sustain that. Let me ask you this question. What do you think are the greatest risk factors to Coinbase? This whole crypto world right now, how do we know we're not in some big bubble and 10 years from now, we're going to be like people was buying cryptocurrency for $60,000. That's nuts. I remember when cryptocurrency was $1,000, $2,000, right? So how do we know we're not living in this big bubble? What is the risk factor that can burst this big possible bubble that we're living in the cryptocurrency and Coinbase world?
Obviously, the regulators could throw a wrench in things. You saw China come out and they're doing a central bank digital currency now. But I don't think that most people are really comfortable with central banks and governments issuing digital currencies,
Mm-hmm.
especially not in the United States. We'll see. But if a central bank or a government issues a digital currency, they basically can track every single thing you do with your money. And that's
Mm-hmm.
not going to fly too well in the United States, at least. Maybe they can get away with it in China, but I don't think it's going to fly in the US. So, long term, I think the regulators actually are going to work with the blockchain and crypto community. You saw Fidelity and Square,
Absolutely.
I think, and somebody else come out and start like a lobbying group, for sensible regulation around blockchain and crypto. So that's a risk, but not a terrible risk. I think in the short run, probably the biggest risk to Coinbase is getting squeezed on their transaction fees, because a lot of companies out there are offering Bitcoin buy and sell services, and you can get better transaction costs than what are out there right now. So that's something that they're going to have to navigate and manage to make sure that they maintain their brand goodwill.
Mm-hmm.
And I think the biggest risk is just that this market and the speculative excesses in the market take the whole market down in some dramatic way. And I think that's not out of the question. A lot of this market has been driven by quantitative easing. It's been going on since the 2008-9 financial crisis, right?
Mm-hmm.
There have been incredible, the spigots have been wide open. And at some point, the Federal Reserve is going to have to tighten. And I thought it would have been by now, but it hasn't been. Doesn't mean it can't go on another 10 years,
Mm-hmm.
but it can't go on forever. And I think that's probably the bigger risk. And I think a lot of people are nervous. A lot of smart people are nervous. And a lot of people got one eye on the exits of this market, saying, how much longer can this go on?
Okay. I have asked you this question here. We're going to touch into those the Federal Reserve and quantitative easing. So we're going to break that down for the listeners that are interest rates and stuff like that. That are like, hey, what is he saying? I don't understand. We got that, and thanks for everybody that's coming. If you're coming in live, tell us where you're from. Tell us where you're checking in from. Tell us where you're checking in from, so we could let Dr. Smith know that he has audience here live, and he'll catch them on the playback. Now, next question I got for you, Doc. You kind of touched this, the U.S. digital dollar. We already saw the Federal Reserve and the Secretary of Treasury, Jane Yellen and Jerome Powell, have already kind of touched about and spoken about creating a cryptocurrency. Now they're looking for opportunities into that space and the blockchain. What do you think will happen to the current state of cryptocurrency if we have a digital dollar?
Nothing.
All right, touche.
I don't think a digital dollar can compete.
Okay, that's okay.
It's not going to do anything to Bitcoin. I mean, it might create a little ripple for a while that some traders can play on, but a digital dollar, nobody wants the US government surveilling every single financial transaction in their life. So I don't think it's going to fly.
All right. Now let's go back to this regulation. What if the government comes out and says, hey, cryptocurrency, you're now illegal, or, slap on the wrist. No more cryptocurrency. We want to stop that, whatever the case may be. You think that's even possible?
I don't think it's possible. I think the cat's out of the bag, and you see tons of institutions embracing it now. So not possible.
Okay. Now I got to ask you this next question. You spoke about this. You kind of hinted on this. You spoke about the quantitative easing. You spoke about your instance in the dot-com bomb, how you was a genius in 1998, 18 months. You went from $10,000 portfolio to a $40,000 portfolio. Yeah. Then, within 18 days, you're like, hey, what the heck happened, right?
Yep.
And now we went into this era. We had the dot-com bomb in 2000. Then we went right into a recession in 2008. Then last year, we had a pandemic that just came out of the blue, knocked us down again. I got to ask you this question. Market cycles, we have the trough, expansion, the peak, then back to a recession. Where do you think we are right now?
I think we're at risk of being near a market top. So every couple of decades, like the first 2 years of every 20-year decade, is oftentimes a period of correction in the markets, and we haven't had that yet. So I would not be surprised to see later this year the markets correct significantly. The middle 4 or 5 years of a decade are typically the best years, like late 22 to 27 or so. So I think that's some risk. I think that the PE ratios are very high right now, and you see GameStop and AMC and penny stocks and options volume is crazy right now. And call option volume is way crazier than put option volume. So I know I'm throwing out some terms here, but penny stocks are going nuts. SPACs are going nuts. NFTs are going nuts, right? So there's just a lot of people with not the usual things to do, and there's a lot of free money getting pushed out by central banks and the Federal Reserve. Another 1.9 trillion coming down the pike. Do you remember, Prince, in the financial crisis when they were talking about $800 billion, you know, and it was like, oh my God, how could that even be possible? And now it's like, a trillion here, a trillion there. You know, what's another trillion? So something has come, you know, something's gotten unmoored here. $1 trillion is a lot of money. And it's just, you know, being doled out willy-nilly. So so that, you know, that's not sustainable. The liquidity will slow down. You know, things will have to be tightened up. And I think that I think a lot of people realize that. I think a lot of smart people are keeping an eye on the exits. And if something unexpected did happen, I think you could see a rapid, fast correction with everybody running for the exits at once.
Wow. Okay. Now, so we got some Israel here. He's from Missouri. And also we got Arthur Buckley here. What's going on, Arthur Buckley? He says from St. Augustine, Florida. Who else put in their location here? Someone said a little ripple. Tactical with a head strap. Headlamp with the strap. Says a little ripple, huh? Okay. Okay. I can't say your name here. He says they are coming. Okay.
How did it cost PayPal and Square? Yeah, they are.
PayPal and Square. I think when you was talking about PayPal and Square, looking at, you know, like you was talking about the overprice of Coinbase and things like that. Now I got to get into this next question. You just hit it, and I got to ask you this: these crazy things is hitting the market. Speaking of crazy things, these things that's coming onto the market nowadays with people are saying, like you just said, there's a lot of money being pushed into the market. You have a lot of money coming in from quantitative easing. Then you have very low interest rates passed on by the Federal Reserve. And then we're just throwing out money left and right with $1 trillion here.
A lot of Bitcoin millionaires out there.
A lot of Bitcoin millionaires. You have all
young people.
young people who just bought a bunch of Bitcoin. Now I got to ask you this question. These NFTs, what do you think about these non-fungible tokens that are coming out where you can sell a picture and people can sell practically anything, pretty much like a digital gold almost? What do you think about these? What are NFTs and what do you think about them?
I think NFTs are great. And I think that the things that are being used to that are being sold via NFTs are not that great, but I think NFTs are really the beginning of what we'll know in the future as digital property rights. Okay. So non-fungible means that, you know, hey, if you've got one Bitcoin and I got one Bitcoin and we trade them, they're the same, right? That's fungible. You don't care which Bitcoin you got. I don't care which Bitcoin I got. All I care is I got one, you got one, we trade them, they're fungible. So non-fungible means that they're not alike, right? So NFTs allow you to uniquely identify any digital asset. Okay. So yeah, right now they're talking about, you know, video snippets of LeBron James and, you know, the
Michael Jordan.
Digital artwork that sold at Christie's for $69 million by Beeple, the 5,000 days. That's just a digital file, a JPEG, right? So I'm not, I can't really comment on its value. Art is in the eye of the beholder, right? And so, far be it from me. It's not my taste in art, but hey, somebody's is, and it's whatever somebody else is willing to pay for it, right? So, but NFTs are really opening the door to this idea of digital property rights, right? So you can literally have digital assets that are uniquely identifiable and that you can exchange value. So NFTs are going to really lead to the securitization and the digitization of a tremendous number of assets. I think it's just getting started. It's going to go from crypto kitties to real estate contracts, so so I think NFTs are really interesting. I think that the prices that they're getting right now for, digital artworks are not something I'd be willing to plunk my money down for. But hey, I could just be, an old fuddy-duddy.
Okay. All right.
But now, the concept and the fact of digital scarcity and being able to really exchange digital assets more like we exchange physical assets, that to me is really the story of NFTs. And that opens up a whole new type of commerce. And that's why I think a company like Coinbase can be so valuable, because I think that the whole marketplace of digital properties, digital property rights, is essentially, unfolding right before our eyes. And I think NFTs are an early indication of that.
I like that. I got to give you. So Coinbase already having 56 million customers. They're ripe to be right there to switch it off into the NFT market.
Heck yeah.
Oh,
talk about diversifying your revenues, right?
Yeah, you talked about that. Now I got to ask you this question, Doc. These market cycles you have coming up here, I don't know when you have it coming out yet, but you say you teach people about the market cycle. You got them the Risk Manifesto, right? Yeah. Where you talk about the market cycles, and you're saying we're on the 38th floor of this tall building. Doc, I'm 36 years old. I'm 35 years old. I'm 25 years old. What the heck am I supposed to do with my money? You're telling me we're at the top of the ceiling. How am I supposed to invest my money? I want to I can't put it in a savings account because interest rates are too low, right? I can't keep it in cash. I can't put it in a savings account. Everybody else is making money. The stock market is booming. Real estate market is booming. What am I supposed to do? Am I supposed to sit on the sideline and try to figure this out? You spoke about this when you were speaking about market risk. So can you hit on that market risk? Tell us about these market cycles and managing that risk in the Risk Manifesto.
So the idea behind the Risk Manifesto, which is a forthcoming book, it's not out yet, is that the world that we're living in today is really architected on the mathematics of risk. It's architected on probability and statistics. And if you go to a professional money manager, they are managing risk. A trailing stop loss is a form of risk management to limit your downside and unlimit your upside. So the public doesn't think about risk enough. And yet risk and reward are how the world works today. This is how financial markets work. And this is increasingly how even, marketplaces, ad marketplaces like Google and Facebook are working. So the people that are running the networks, the people that have all our data, they know the mathematics of risk. And so people need to start to look at, earlier I said, I'd never put all my money in one stock, right? The Risk Manifesto is about knowing how the pieces of your portfolio fit together, right? So that you can manage your downside risk while creating as much upside risk as possible. Now, I know this all sounds mathematically complicated. When I told my mother about I was going to name my company Risk Smith, she was like, Risk Smith, R-A-S-K? Why would you name it risk? That's not a good thing. Well, I'm telling you, risk is a good thing, right? Risk is how you earn reward, right? Risk is something you do in exchange for the opportunity to earn a reward. And if you're not taking risk, you're not going to get any rewards. You got to take smart risks, but you do have to take risk. There's no such thing as a free lunch, right? There's no such thing as a risk-free game. So, I mean, unless you're going to be in 30-year treasury bonds or something, right? So you have to understand that risk is something that you can manage. You have to become more knowledgeable about risk. You got to be able to quantify it a bit. And you have to see how the pieces of your investment portfolio, work together to minimize your downside and maximize your upside. So that's what I mean by the Risk Manifesto. I'm trying to really just educate the public that risk management is something that no professional would be without, and yet the public basically ignores it completely. Jack Schwager is the author of the Market Wizards books, right? So I interviewed him on Cycles TV recently. And, I said, Jack, what do all the market wizards have in common? And he's like, well, pretty much nothing, except they all have a pretty rigorous commitment to risk management. Okay. So he's interviewed 100 market wizards, and the only thing they have in common is risk management, right? And then he said, and 90% of risk management boils down to knowing when you're going to sell before you buy. So with one act, right, of knowing when you're going to sell before you buy, you can join the market wizards 90% of the way. So it's a serious topic, and it's one that the public just doesn't understand. I think I have some history of making complex ideas accessible and intelligible to the public. And so that's what I'm working on in my book, and also in some new financial technology that I'm building that I'm hoping to launch later this year.
Okay. All right. Well, Doc, we definitely went over the time. I know. Definitely went over the time, but time flies when you're having fun. A lot of great knowledge there. Definitely like that. So is there anything out there you want to leave this live audience and the playback? Because tell about Cycle TV, right? You do have to tell us about Cycle TV, but how can people get in contact with you, stay with you, follow you, and things like that?
I have a website, drrichardsmith.com, drrichardsmith.com. And I just launched a new newsletter that I call the Risk Rituals. So talking about this area of risk education, I've taken the word risk and broken it down into an acronym. R is for rest. Before you take the plunge, think about whether this is something you really want to do. I is for invest. Once you've decided, you're in, then by all means, take the step, invest. S is for stick to it. Once you've committed, don't look back. And then K is for keep your gains. So anytime you're facing a risk, you have to think about it. You got to rest. You got to invest. You got to stick. You got to keep.
What was the R again?
Rest.
Yeah. Okay.
Because this isn't, investing is not just about betting on the right horse. It's actually about helping create the future.
Okay.
And so, that's partly why I want to invest in Coinbase, because I think they are creating the future that I would like to see happen. And that's one of the things you do as an investor, is you loan your capital to enterprises that, you think are going to pay you back, but ultimately also enterprises that you believe in and that you want to see more of.
Got it.
So people should stop and rest before you invest.
There you go. We got it right there on the stream from Mrs. Benjamin. She says, rest, invest, stick to it, keep your gains. All right.
That's it. Risk.
Our partner says,
the risk rituals.
The risk
So
rituals.
yeah, check out drrichardsmith.com. Appreciate it. And hopefully you'll learn something.
Okay. So Doc, definitely, ladies and gentlemen, I thank you guys and girls for tuning in to catch us live. You already heard Dr. Smithy. He already said, check out Dr. RichardSmith.com, right?
Yes, sir.
And then you also got Cycles TV, right?
Yep. We have a YouTube channel, Foundation for the Study of Cycles, and you can learn more about us at cycles.org.
And also
cycles.org. We are a not-for-profit 501c3.
Nice. Okay. Well, Doc, I definitely appreciate you for staying on. We'll chit chat here in a second, but we're going to check out everybody. Into the next video, podcast, cartoon, or whatever else crazy you see me do around the globe. My name is Prince Dykes. Peace, be safe. I'm out, and thank you.